Alright, continue from the previous part. This is what advice you can do, and you can help other people or yourself even if you encounter loss aversions symptoms. Okay, forget even it is if you, let's say you wanted to hold into the losing stock for too long, you should be aware. You should be beware of those symptoms when you are holding to a losing stocks for too long, because it is harmful for your investment's health. One effective remedy is to stop loss rule. You may, for example, agree to sell a security immediately if it ever incurs a 10% loss. You put a stop loss. However, it is best to consider an investment's normal expected level of volatility when devising a stop loss rule. You don't want to be forced to sell if an investment's price is just exhibiting its customary ups and downs. So looking into the trend itself, some stocks are very volatile. Looking into the trends, how volatile is the stocks, as you can predict based on its performance, how volatile it goes up and down. However, if there is an excessive going downwards trend or excessive losing money, put a stop loss to how many percent that you want from the ordinary volatility. Alright, so for take the money and run diagnosis, this is you are too quick to sell the winning profitable stocks, afraid of losing it later. So loss aversion can cause investors to sell winning position too early, fearing that their profit will evaporate otherwise, meaning to say the stock will later go down. So this behavior limits the upside potential of a portfolio and can lead to the over trading, which also reduce returns. A stop loss can also help to institute rules for selling appreciating investment. As the stop loss rules, price appreciate rules works best when tailored to reflect detail related to fundamentals and valuation. The goal is to let gains run, meaning to say, if it does not exceed a certain price that you put on, then don't sell it, or else sell it if the price does not reach that. So you put a stop loss by looking into your fundamental and evaluation of the investment. Okay, how high can the price goes up, so you can evaluate doing fundamental analysis, and if it's already reached that price, then you can sell it. All right. Next, taking on excessive risk. It may be helpful to educate client about an investment risk portfolio, taking time to discuss items like standard deviation, credit rating, buy, sell, holds rating, and so on. The investor will then hopefully make the right decision to protect the overall portfolio and jettison the risky, poorly performing investment. So meaning to say, they let go of the risky, poorly performing investment. And fourthly, unbalanced portfolio. Education about the benefits of asset allocation and diversification is critical. Yet, it may be insufficient if an investor's hold on a concentrated stock position with emotional string attached. It is useful questions in this situation if you have emotional strings attached to a particular stock, that ask yourself, if you do not own any XYZ stocks, would you still want to pick up as many shares as you own right now? If and when the answer is no, some leeway for maneuvering emerges. Okay, meaning to say there are rooms for you to sell it off lah, because there is not too much emotional attached to that particular stocks. Tax consideration such as low cost basis sometimes a factor in, but certain strategies can be employed to manage this cost. So you need to be able to tell the client of the tax consideration, other costs, administrative, trading costs, and so on, that might attach, that might be a strategy to check on your unbalanced portfolio. I think that's about it. Thank you very much.